You've heard the phrase a lot recently about alternative facts, but can you invest in an alternative reality? 2016 was a year to forget for equity investors. The FTSE JSE to return what, 2.6%? Offshore returns were even poorer courtesy of a stronger rand. The MSCI World Index was down in rand terms, 4.6%. But one of the interesting things to come out of last year was the fact that the performance of equity products offering alternative exposures did rather well. This is The Moneymakers. I'm Bruce Whitfield. Tonight we discuss investing in an alternative reality with only one set of facts by closely looking at trackers like CoreShares, DivTrack, Satrix, RAFI 40. Both returned double-digit growth. I'm joined by Brian McMillan from Investec Financial Products. There is an alternative universe to just watching the top 40 index, Brian.
Sure, and we've seen, as you say, the numbers there. Those are really ETFs that are doing what is now called smart beta. So they're taking indices and trying to shape them. You know, it's a little unfair on the top 40 for the last 2 years, flat over the last 2 years or 2.5 years, because within that there's been sectors that have performed very well and sectors that have performed poorly, and they've kind of pulled the top 40, two different ways, and we've ended up flat.
I mean, if you'd gone 2015 and you'd gone long in the top 40, you would have done very well as the currency depreciated off the likes of British American Tobacco. SAB Biller deal would have been in there. Sure. You would have done really well those, and resources would have killed you. And then last year, as the currency strengthened, you were killed on Richemont, you were killed on British American Tobacco,
sure,
at AB InBev, and resousces rescued you on that particular front.
Yes, and that's why we've kind of ended flat. So, that's one of the pitfalls of investing in index investing, and theoretically active managers should do very well in those kind of situations relative. What we haven't seen is that actually happening. So, we saw active managers basically following the market, and again the top 40 is a little unfair because it has that high weight to Naspers now. And it has that high rand hedge component. But certainly on an international scale, where you're looking at equity investing, and certainly the South African investor who doesn't have the ability to go and pick individual stocks in other markets, we believe should really be using things like index investing, the S&P 500.
But how do you get, you call it beta, I mean in English we'd call it outperformance. How do you get beta in the index world?
Well, beta is the index itself. Alpha is the magic one.
I beg your pardon.
Yes.
I'm never being much good at Greek.
And that's the big word. Is there such a thing as alpha even? Many investors, active asset managers over the last 10, 15 years haven't really been able to provide much of that after their fees. In fact, Warren Buffett's got a bet that ends at the end of this year, which he's winning hands down, which is to say that the S&P 500 will outperform a bunch of active managers after fees. And over a 10-year period, he's well up. So really, there has become this big talk of whether you go passive or where you go active. And what we're trying to do, within the financial products that we do, is try and provide access to those markets for investors. So into foreign markets where it's very difficult to go across and say, I'm going to buy Apple, I'm going to buy Alphabet, I'm going to buy Amazon. How do you actually do that? And we like to put together ideas where you can actually do that, but do it on the JSE.
Past performance is no indicator of future performance. We accept that. Okay, fine.
Absolutely.
See, I've listened to financial services ads long enough to know that. But there was a great story on Bloomberg just last week in which it said, over the last 100 years, the JSE has been the best performing stock market. Now, I'm not 100% sure about that. Certainly the JSE, according to Morningstar, in dollar terms over the last 100 years, is one of the top three. In that top three, Australia, the United States, and South Africa. It's a pretty close run thing. It's counterintuitive that South Africa, over a 100-year period, is such a stellar performer. And maybe we've run out of runway. But why get complicated and fancy with investments if the last 100 years have delivered one of the top 3 performances worldwide for a century?
And Bruce, even if it is the top 3 or 4 or 1, it's certainly up there. And I've seen it in my lifetime. The JSE Top 40 Index in my working life has continually grown over the years. Sure, we've had a pause for the last year or two, But what that is saying is that you have to be invested in equities.
Yeah.
You have to be invested for the long term in equities. And, you know, we really advocate that. And we say, you know, even if the markets are very high, you know, you think personally the market seems very high at the moment, well then, you know, invest in the market and maybe have some protection for the downside. But the major thing is to be invested in that market.
But you're not answering the question. It was very neatly dodged. But why make it complicated and go global when history teaches us that South Africa has outperformed most of the world over 100 years?
Well, well, when you say why make it complicated, and we're not. We're saying, you know, buy the indices, buy the ETF type trackers, and maybe put on something like a bit of protection if you feel it's too high, or maybe even buy gearing.
Do we need to globalize? And I ask this because most of the top 40 earns most of its money outside of South Africa, or certainly it gets dollar revenues. Whether you're talking about, are there any gold shares left in the top 40? I think Goldfields is back in there. Yes, it was briefly, but certainly they either make dollar revenues, or they're based in Europe. For example, Steinhoff is in there. Shoprite is making buckets of money all over the continent. Richemont, Naspers, for goodness sake, is making most of its money in China. Why worry about what Apple is doing and Nike is doing unless you're a particularly pedantic market follower and you want to have some of those fancy American shoes and fancy American cell phones?
Well, we all use those fancy American cell phones. We all have those shoes. So we're a part of the global economy, and you know, for the South African index that might have one stock, Naspers, that is really an information technology stock, or one of these new type stocks. You know, many people would say that's just, you know, only one of them. Why have only one when you can have, you know, a diversified one? And we saw it a few years ago with BlackBerry. BlackBerry was everything. I'm sure you had one. I'm sure you don't have one anymore.
I had one briefly. I love the Nokia 3310, and it's coming back, which is most exciting. But the world is an increasingly uncertain place. One looks at valuations in the United States, and Warren Buffett may very well be right. But we talk about political uncertainty in South Africa. The United States has got it in bucket loads. They've also got interest rate uncertainty in the United States, and growth uncertainty in the United States. Where do we go for comfort, safety and growth, if that's not a contradiction, in the ETF space as a South African investor?
Sure. I think what it comes down to, as you said, there's three markets. Ourselves, the Johannesburg Stock Exchange, the US market, and you mentioned the Australian market, I think, is also, you know, one of those top threes. And we're saying, why not diversify yourself? You know, you don't necessarily have to have, it's very unnatural to have all your investments in one country. South Africa is less than 1% of the global economy.
What we did learn in the finance minister's budget speech, for those of us who were paying attention, was there are only 103,000 people in South Africa who earn more than R1.5 million a year. Those are the people you're talking to right now. For the rest of us schmucks, do we have the capacity to diversify? How do we diversify?
Well, I think we're talking actually not those 1,500 people at all, because
103,000 who got 1.5 million.
Yeah. So those people would probably have actively managed portfolios. We're looking at the people who have from tax-free savings, you know, from 30,000 Rand up to, you know, R500,000 to invest. And for them, it is almost impossible to diversify without using ETFs. Yep. So certainly that's where they could come in.
And it's about cost effectiveness, because, I mean, the cost of investing, especially if you're trying to get money offshore, is what destroys the value of portfolios after 20 or 30 years.
Absolutely. And you know, as you say, over the long term. So we want to encourage people to be in the market for as long as possible. And the ease of use of some of these products, some of these ETFs or capital protected products, is the major, major selling point for people that can get in from a small amount.
Traditionally, those of us who understand financial products from 10 and 20 years ago, any capital protection costs you more than half an arm. It's traditionally very expensive. Is it much cheaper now?
Certainly it is much cheaper. I think I think there was definitely a period in time when things were perceived to be more expensive, and certainly there wasn't transparency around fees, that sort of thing.
Is there enough transparency around fees now?
Absolutely, I would say, purely because of competition. Ourselves, all the major banks now produce these types of products. A lot of them are listed on the JSE. That means you get daily pricing. Liquidity has increased in them. You get daily liquidity, whereas 10, 15 years ago, you weren't getting that kind of thing.
It's becoming quite a competitive space as well, and more and more banks. I know Standard Bank, for example, has recently got Stanlib to build a whole bunch of products for it. They call it the Goal range, or Goal Scorer, or Goal Protector, or something. And they've got a whole range of products like that. They put their own brand on it, gives them something to sell. This is a salesman's world in terms of selling investment products. Sure. It's quite competitive.
Certainly, I mean, they have to be sold, and these types of financial products are products that are sold, or have been certainly to this point. But the fact that there are more and more of them in the market, and that they offer more choice to people, has meant that prices have come down, liquidity's increased, and you can get into these types of products with a level of capital protection that kind of opens it up to people who would never have invested before in markets.
But how do those people begin the process? Because unless you've got a PhD, it feels like, to make comparisons between financial services providers, financial products, and understanding really what is at play within these products, it's pretty scientific stuff.
Sure, and Bruce, I mean, I know ourselves and all the other banks have done quite a lot of education in the market. These products started off, 20, 30 years ago, purely in the institutional space, and what's happened to them is over time, they've become more and more retail focused. We spend a lot of time with financial advisors, with stockbrokers, going through this. So, most stockbrokers and financial advisors now, over the last 10 years, have really got up to speed on these kind of things. And again, it's really about opening up this to that space where traditionally people wouldn't have been invested in markets or in stock markets because they were too scared. They're scared of losing money. If they get a level of protection on the downside, it makes them feel more comfortable to put money into these
Brian
things.
McMillan, thank you very much indeed. Brian McMillan is from Investec. There'll be more issues around alternative and other interesting realities about investing, of course, broadening your views on the world of investments. And can you believe it? Yep, South Africa is certainly one of the top 3 places in the world to invest for the last 100 years. But past performance is no guarantee of future success. Good night and have a good evening. Bye-bye. This is The Money Makers. I'm Bruce Whitfield. Good evening and welcome to the show. Recently, Discovery had its annual financial planning summit, and one of the guests was Isabelle Lago. Was that close?
Yes.
That's very good. She is from Blackrock. She is a global strategist with Blackrock, and she's got her finger on the pulse of what is happening in global markets right now. Do you worry about politics? Does politics make you panic? We panic about politics a lot in South Africa, but globally, politicians are all going mad. Do you worry about it?
We worry about it, but I would say we don't panic. We try to look through the noise. In fact, if you look at the way markets reacted to, frankly, earth-shattering political events like the UK decision to leave the EU or the election of Donald Trump, actually within 48 hours, things were almost back to normal or even looking better. And we think that's really the key lesson to take away from this is don't get overexcited. Don't try to react to every little bit of political news, and look at what are the fundamental drivers of market performance, and you'll do just fine. Having said that, there is one element that we're looking at closely, which is the trend towards more populist, nationalistic, anti-market policies, which so far has been much more a matter of rhetoric than fact, most strikingly in the area of global trade. But that's obviously something we're watching very carefully, because it would be very detrimental to global growth if it was turned from rhetoric into action.
Typically, one's got to try and identify which is rhetoric and which is policy statements. And I mean, Donald Trump makes policy statements on social media, for goodness sake. It's quite hard to discern the difference between the two. So how do you differentiate between what is noise and what could translate into fact and not be caught on the wrong side of a market?
Well, as I said, the first thing is don't overreact. You know, policy making in most countries actually takes time. It's not a matter of firing off a tweet. And so if you look at the process around US tax reform, for example, you know, it is going to take time to get a majority in Congress, maybe as well try to get one in the Senate to pass a plan through. So there's no need to jump around. We're just following very closely the way the debate is evolving in Congress, in the White House, and we just have realistic expectations of the kind of timing. And we think, you know, probably now more early next year than earlier than that. We try to have reasonable expectations around the size of what's eventually going to come out of this process. But it's a slow moving process, and it's the same with trade policy. It's the same with, you know, most policies you don't do on a tweet. There's a process, and so you can see it coming.
I mean, the longest bull market in history, I think 1987 to about the year 2000, and then of course the dot-com bubble burst, and we had the attacks on the World Trade Center and the war on terror. I mean, that changed the world fundamentally. That was a 13-year bull market. We are, what, 9 years into a bull market now, the second longest bull market since 1926. At what point does this bull market come to an end? And does it have to be a dramatic end? Or is there a slow fizzle? Or does a bubble burst? How do you see it?
So that's a very fair question. And I think you're right. Given how far along we are in this territory, it's worth asking. We don't see a bubble right now. We don't see exuberance in the market, in market prices. In fact, if you look at the equity risk premium, it's you know, well above the long-term historical average. So, and you know, the fact that volatility has been very low is not that atypical in periods of expansion when you have pretty strong stability around growth expectations. So we don't see anything that would make us anticipate that we're near a top of a bubble. If anything, when we look at, you know, the pace of this recovery in terms of macro fundamentals, we think we're closer to mid-cycle, and that this expansion, you know, the room to run is measured in years, not in quarters. And so we think there are drivers for this market to continue. That doesn't mean you can't have adverse shocks, that you can't have surprises, but barring that, we're quite confident this can go on for several more years.
So I mean, you talk about you can have short-term shocks. Nassim Taleb, of course, taught us around the time of the financial crisis with the black swan, that these things come around every 100 years, and suddenly one did come along, and you don't know that it's a black swan until it's a black swan, until it's right on top of you. I mean, there are risks on interest rates in the United States. There are risks in Europe on growth. There are risks as to what Vladimir Putin actually does think. There are risks in China, as you explained from the podium this morning, that if China doesn't manage its economy effectively, that could be a very severe trigger for the whole world in terms of growth.
No, I think that's absolutely right. There are triggers, and I would say the main two at this stage that we see are, as you pointed out, China, and more specifically a sort of mishandling of the deflating of the credit bubble that they do have there. It's very hard to do, slowing down a credit growth surge. You can engineer a soft landing, but it's hard, and the accident risk is elevated, so that's one. The second risk is a policy mistake around central bank policy normalization, either in the US or in Europe, or potentially Japan, although Japan tends to have fewer global spillovers than Europe or US. So there are these risks, but what I'm saying is the fundamentals are pretty healthy. In 2007, you didn't have a black swan coming out of nowhere. You had a degree of leverage in the global financial sector that was astronomical, and that's no longer the case.
No, and that's an important differentiator to make. So a lot of people, I mean, if you, again, I don't know how active you are on social media, but depending on who you follow, the bubble merchants are vociferous and are warning, and they've been warning for the last 3 years that the bubble's going to burst. Oh, every day that comes closer, every day that goes by, what comes closer. They'll be right one day.
They'll be right one day, no, absolutely. But, you know, you can be wrong for many more years, and if you sit it out, you're just missing out on a lot of you know, return opportunities, and that's just not a great strategy in our view.
Yeah, and you talk about the need to take risk.
Yep.
And how global investors are, perhaps surprisingly for us as South Africans, because we tend to see the worst of ourselves, looking at the South African bond market and going, actually the returns are pretty good in the South African bond market. We see continued currency strength despite our politics, despite sacking of finance ministers, despite a president looking as if he's gone rogue on us. Markets, for some reason, for now anyway, are discounting that.
I think that's right. Look, we're still in the universe of very low returns in advanced markets, and that's going to continue for the foreseeable future, frankly, because that's driven by very long-term structural trends, demographics, high debt burdens, low productivity growth. And so there is search for yield. That's still going on, and that's pushing a lot of investor flows where the return is, and emerging markets is an obvious place to go, I think.
Counterintuitively, yeah. I mean, you showed a graph at the presentation earlier today, but precisely that, how emerging markets continue to outperform other asset classes.
Absolutely.
It's a big basket, though, of the emerging markets.
It's a big basket. And, you know, interestingly, last year, when the flows started coming back in, which was around the middle of the year, it was driven by passive flows, so people were sort of indiscriminately going into emerging markets. Year to date, about 2/3 of the flow are from active managers, and so we're starting to see people getting more careful, not just buying the index, and you know, to the extent that that continues going forward, that could have implications for South Africa if the politics gets more unruly.
I mean, as a global strategist, when you look at countries that are being downgraded, on the brink of downgrade, especially to sub-investment grade, as we're teetering on the very edge of sub-investment grade, it only takes Moody's to get cross, and we're in all kinds of bother. Do those investment grade ratings matter as far as you're concerned?
Well, they do and they don't. I would say, you know, one lesson that investors learned from the 2007 crisis is, you know, believe credit rating agencies at your own risk. So investors do their own due diligence. They don't look blindly at credit ratings, but there are threshold effects coming from the way the investment mandates are formulated. And if your investment mandate, you know, tells you can only invest in investment grade securities, well, obviously, when a country loses that investment grade rating, a lot of people are going to be forced to exit. So, but outside of these thresholds, it's not a dominant consideration.
What do you see as the biggest risks for emerging market investors right now, as we're in an emerging market? Is it that the US economy continues to recover? Janet Yellen or her successor continues to raise interest rates. It takes those automated flows back into developed markets, and we see the cycle that you describe, that we're midway through, continuing to benefit, and that begins to count against us as emerging markets? So
I'd say in the baseline, the main risk is idiosyncratic, and we've seen it in Brazil. We could see more of it here. You know, don't shoot yourself in the foot, I would say.
If we'd taken our shoot ourselves in the foot team to the Olympics last year, we would have won a team gold. We're very good at that. But yeah, we keep doing that, and you know, it's going to count against us eventually if we continue.
Indeed. Other than that, you know, we're not worried about the US normalization, policy normalization, having a very detrimental impact on emerging markets, because we expect it to be very gradual. So gradually higher interest rates, gradually stronger dollar, but no shock. And so this is something to which emerging markets should be perfectly able to adapt. The only risk would be, again, completely new policy at the Fed after the change in leadership, you know, in the first half of next year.
How big a risk is Donald Trump? Not only to the United States, but to the world.
Look, some of the policy intentions that he talked about, such as you know, putting tariffs on trade with Mexico and China and others, would be a dramatic risk for the global economy. But so far, he hasn't acted on them. So it is a risk. It is definitely a risk. We can't pretend it's not there. But so far, so good.
So far, so good indeed. Isabelle, thank you very much indeed. Isabelle Lago, she is a global investment strategist with Blackrock. That's it from the Moneymakers this evening. Lots of food for thought. Thank you so much for watching. Good night.